Welcome to a very special episode of Behind the Curtain, hosted by me, Mehdi Amini, CEO of United Legacy. Today, we're diving deep into the pulse of current trends affecting our world, from the surprising emptiness of the office spaces across the US to a critical look at what the jobs data is really telling us. We'll explore the twists and turns of interest rates, celebrate the latest achievements of Bitcoin, and offer guidance for those navigating the 2024 real estate market. Plus, we're shining a spotlight on our successful Wealth Waves events and the invaluable workshops we've got lined up designed to empower you with financial knowledge that you need. Whether you're a digital currency enthusiast, pondering your next real estate move, or keen to stay ahead in the finance game, this episode has something for you. Let's peel back the curtain and uncover the stories shaping our future. Wealth Waves series, events, and workshops. Our latest Wealth Waves events, held at Ruth Chris in Honolulu, Hawaii, were an overwhelming success. I'm so excited. It exceeded all expectations. We had over 300 attendees across 8 fully booked sessions in just 7 days. The enthusiasm and engagement from our community were nothing short of spectacular. The demand was so high that we ended up with a wait list of 41 individuals eager to join us. Such an achievement speaks volume about the growing interest and support for Wealth Waves. Riding this wave of success, we're excited to announce that we will be hosting another 8 sessions at the end of March at Ruth Chris in San Diego, California. We warmly invite those who have not had a chance to attend a Wealth Waves event yet to book their spot right now. Please feel free to bring your friends along. For our out-of-state community members or those unable to attend in person, remember that we offer monthly Wealth Waves on Zoom. This ensures that no one misses out on the valuable insights and networking opportunities we provide. In addition to our highly anticipated Wealth Waves events, we're thrilled to announce a series of upcoming workshops designed to empower our community with essential financial knowledge and strategies. Our trusted advisors, experts, and their respective fields will lead these sessions covering a range of critical topics: investing into our fund, investing into trust deeds, tax strategies, the importance of estate planning, among others. These workshops are designed to equip you with the knowledge and tools necessary to navigate the complex world of finance, wealth management effectively. Whether you're looking to expand your investment portfolio, you might be thinking to yourself, I want to optimize my tax strategy or ensure your legacy is preserved. These sessions are invaluable opportunity to learn from the best in the business. For details, dates, times, and how to register for these workshops, please visit our website at www.unitedlegacyus.com. Spaces are limited, so we encourage you to secure your spot early. Let's continue to grow and protect our wealth together. New guidelines. We're all trying to navigate the 2024 real estate landscape. The real estate market of 2023 posed significant challenges for prospective home buyers, marked by soaring mortgage rates, inflated property prices, and a stark scarcity of available listings. We all felt it. This environment understandably deterred many from pursuing their dream of home ownership. That's the real story. So as we venture into 2024, a glimmer of hope emerges, prompting the question, will this be the year home buyers find relief? Well, we got to think about that. For those considering a home purchase in the near future, it is essential to shed the discouragements of the previous year and adapt to the evolving market dynamics. We read an article, and this article that I'm going to review with you delves into the outdated home buying approaches and introduces the fresh strategies poised to define the 2024 real estate experience. Let's go through that. Number one, reassessing mortgage rates concerns. The old outlook, or an outlook that we all have, is the deterrent of high mortgage rates makes home purchasing unfeasible. Supply demand, can you afford a home? Well, the new outlook should be softening rates diminish the barrier for potential buyers. Number two, preparing for increased competition. The market was so saturated, and the old strategy was that buyers enjoyed minimal competition. The new strategy is ready yourself for heightened competition for homes. Number three, seller flexibility emerges. The old norm was sellers based a strong market had little incentive to offer concessions. We all know that. Today's market, an openness to negotiation leads to potential concessions for buyers. We're getting that in every deal that we're negotiating. We are getting deals. So let's talk about the evolution of the offer. The old requirement was that the buyers felt compelled to present their utmost offer to catch a seller's eye. The new requirement is, considered offers have a chance in today's market, and they're open. It's a negotiation. You don't have to close in 7 days with no inspection and no appraisal and pay a couple $100,000 above value. Number five, the rise of soft offers. The old approach was you got to put your offer in like today, immediately. It has to be a formal offer, all of the above needed for you to compete. And now the new approach is initial informal offers. It's an open door to negotiations. Number six, shifting investment perspectives. The old philosophy was quick flips for rapid gains. The new philosophy, the wisdom of long-term investment outshines quick flips. So what are we saying here as we go through the list of six? Old way of thinking, new way of thinking, because we practice real estate, we practice capital markets, and it's always changing. Interest rates will change, numbers will change, you got to change with it. So as we navigate through 2024, these updated guidelines will serve as a beacon for individuals embarking on the home buying journey. By embracing these new strategies, buyers can approach the market with confidence, ready to make informed decisions that lead to successful home acquisitions. Office vacancies, major subject, especially here in the Golden State of California. Vacancy rates are skyrocketing right now, believe it. Even though many companies are calling for remote workers to come back to the office, recent data indicates that the office vacancy rate in the United States is on the brink of reaching 20% for the first time in its history, surpassing even the peaks experienced during the pandemic, where rates never exceeded 19%. Consequently, the value of office buildings has plummeted, now nearly 50% below their peak values, highlighting the impact of these trends. A Canadian pension fund recently divested its 29% ownership in a prominent New York office building, selling its stake for just a mere $1. This move came after the fund had invested $71 million into the property, which is currently burdened with another $220 million loan, or I should say mortgage. So this shift underscores the transformative effect that remote work has had on commercial real estate landscape. The banks continue to be significantly vulnerable to the commercial real estate sector, holding an all-time high of nearly $3 trillion in outstanding loans as of January. And now the banks, if you guys remember, it was about a year ago that these banks, like Silicon Valley Bank, First Republic Bank, had to start borrowing money from the federal government as there was a run on the bank. And let me tell you, these commercial loans are due and it's going to blow up. Keep your eyes on the commercial market. Bank Term Funding Program expired this week. What's going to happen with all of the banks? The Federal Reserve's Bank Term Funding Program, BFTP, established in response to the last banking anxieties, concluded its operation on March 11th. Initiated after Silicon Valley Bank's collapse, this program was crucial in ensuring banks remained solvent during a turbulent time in our nation's history. New York Community Bank, which acquired Signature Bank amidst last year's turmoil, saw its market capitalization at $10 billion just 10 months ago. However, today, its stock has plummeted by over 90%, reaching its lowest point since 1995. And it may be on the brink of failure today. As the financial landscape begins to stabilize, the Federal Reserve is winding down the BFTP, adjusting loan interest rates to deter any last-ditch efforts to borrow. Now, going forward, banks will revert to the traditional discount window for emergency funds, a move that signals growing confidence in the banking sector's resilience. So as we turn this page, it will be very fascinating to observe how banks adjust and what this transition reveals about the Federal Reserve's upcoming strategies. Keep an eye out. The financial world is never short of a surprise. Jobs data revision. Is the jobs data painting the full picture here in the United States? The recent developments in the job market data could prompt a reevaluation. The Job Labor Turnover Report, or JOLTS, has just been released, beating expectations initially, suggesting a positive economic trajectory. However, a closer look reveals a pattern of adjustments that complicates the narrative. December jobs openings were revised down by 137,000, marking a trend where 6 of the last 8 months saw downward revisions in the JOLTS figures. The story deepens over the past year, with 10 of the last 12 months witnessing initial job report figures being revised down. These aren't mere tweaks. They often indicate that the initial reported job growth didn't meet expectations. In fact, considering these revisions, the U.S. saw a net loss of over 280,000 full-time positions. This contradicts official reports that we have celebrated job growth for 3 consecutive years. These apparent discrepancies isn't explained by the replacement of full-time roles with over 900,000 part-time positions, suggesting that holding multiple jobs is becoming increasingly common. These continual adjustments lead to a pivotal question. Is the labor market as strong as it's reported to be? rate cuts. Interest rates are currently lingering around 7%, a stark contrast to the 3% seen in 2021. With the most recent CPI reports coming in hotter than expected, rate cuts are seeming less and less likely in the first half of the year. In the initial 8 weeks of this year, we've witnessed a shift from the anticipating 7 rate reductions starting in March to the 3 in June, and now we're facing a scenario with no cuts in sight and the possibility of an increase instead. The Federal Reserve, along with Jerome Powell, suggests they're taking a data-driven approach, implying that rate decisions will be based on emerging economic indicators. This, if the stock market continues to reach new heights, it's unlikely we'll see rate reductions anytime soon. Conversely, the potential discontinuation of the bank term funding program could emerge as a significant factor that might disrupt the current stability, potentially prompting the Federal Reserve to reconsider and possibly start reducing rates earlier than anticipated, possibly starting in July. The impact of lowering interest rates on the residential housing market remains uncertain. Back in 2007, when the Federal Reserve started to cut rates, it didn't halt the declines in property values, which continued to drop for almost 4 years until the housing bottomed out in 2011. However, today's housing market is distinct, characterized by low supply, and many homeowners holding 30-year mortgages with rates below 4%. There's a split in opinions. Some argue that lowering interest rates could propel property values even higher, while others caution that given the already scarce inventory, the new home buyer interest plummeting, skyrocketing homeowners insurance, even a minor increase in available homes could have a significant impact, especially with rates still at 20-year highs and home values at an unprecedented levels. What's your take on this scenario? Bitcoin. Today I got some exciting news to share about Bitcoin, a type of digital money that many people use kind of like dollars or euros, but entirely online. Guess what? Bitcoin's price just hit a record high of 73,000. This is a big deal because the highest it's ever gotten before that was 69,000 back in 2021. A while ago, things didn't really look good for Bitcoin. Its price dropped all the way down to 15,000 from its high as 69,000 when the people in charge of the money in the US, the Federal Reserve, made it more expensive to borrow money. But despite all that, Bitcoin managed to climb back up, proving a lot of people wrong who thought it wouldn't make it. Something else really intriguing just happened recently. A new way to invest in Bitcoin was introduced, making it actually easier for everyone to buy it, just like they would with stocks in their regular investment accounts. This new thing is called a Bitcoin ETF. And since it started, people have put a whopping $58 billion into Bitcoin. To give you an idea of how huge that is, it's almost as much money as what's in the biggest gold investment fund out there, which is about $98 billion. Now let's talk about something called Bitcoin halving, which is coming up in just 40 days. Bitcoin is designed to be scarce, meaning There's a limit to how many can ever exist. Only 19 million Bitcoins. This scarcity is part of why some people think it's valuable. The Bitcoin halving is an event that happens about every 4 years, and it's a big part of why Bitcoin is scarce. Right now, people all over the world use powerful computers to process Bitcoin transactions. And in return, they get some Bitcoin as a reward. This is called mining. But every 4 years, the amount of Bitcoin they get for their efforts is cut in half. This is what we call halving. Why does this matter? Well, it's like suddenly there are only half as many new gold mines being discovered. If there's less new gold or Bitcoin coming into the market and people still want it just as much, it might make each piece of gold or Bitcoin more valuable because it's rare. So with the Bitcoin halving coming up, making Bitcoin even scarce, and all the new money coming in from people investing in Bitcoin ETFs, it's very, very exciting time with Bitcoin. It's not just for computer geeks or financial experts anymore. It's starting to be a big deal for everyone, kind of like gold, but digital. That's all for today's special episode of Behind the Curtain. It's been an incredible journey through the changing landscapes of real estate, office space, the intricacies of the job market data, the unpredictability of interest rates, the thrilling Bitcoin story, and the strategies tackling the 2024 real estate market. Our Wealth Waves events and upcoming workshops are just the beginning of how United Legacy aims to support you. We're here to help educate you and our community. Remember, knowledge is the first step towards making informed decisions that can shape your future. I'm Mehdi Amini, thanking you for joining me on this exploration. Stay curious, stay informed, and let's forge a legacy together. Until next time, take care.